Hey Bowtie Nation, Joseph Hogue with your weekly market update, 9 a.m. Eastern, every Monday morning with the stocks to watch and the economic news you need to see. And the bull market is back with one thing really boosting stocks above all others, these massive share buyback programs. Confronting a slowing economy and weaker earnings growth, companies are spending billions buying back their own shares, and it's driving stock prices higher. Apple alone announced the largest repurchase ever, buying back $110 billion of its own stock, and I found 5 others you need to be watching. I'll reveal those and why buybacks boost stock prices in today's main topic. Stick around after that. I'll show you the stocks I'm watching this week and the economic news that will guide the market. But first, if you've ever wondered what's in my portfolio or want to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. The app was created by YouTuber Brandon Beavis for investors by investors, and I just started using it last year and love the app for getting ideas and sharing my own portfolio. Now, this isn't just another investing app, though. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across the entire group. You'll also be able to join more than 100,000 investors in the social feed to see what everyone is talking about. I've shared my portfolio on the app and it's totally free to download. Just look for the link in the description below or check out the QR code here. Back to our main topic though, because Apple announced a $110 billion share buyback program last week, the largest in US history, helping it to send the shares up by almost 6% on the news, even in the face of slumping revenue numbers. And in this, the Cupertino giant isn't alone. Total share repurchases by S&P 500 companies are expected up 13% this year to $924 billion. And could reach over $1 trillion by 2025, according to Goldman Sachs. That would be a big turnaround from the 14% drop last year and continue the last decade's trend higher. I'll explain what a buyback is and why companies are repurchasing their own shares, along with the 5 stocks to buy with massive buyback programs. But the very core of this is that increase in buybacks is boosting earnings per share, and that's supporting stock prices. So the 13% increase in buybacks this year and the 16% next year could mean the bull market keeps on charging. Now, a buyback or a share repurchase program is just what it sounds like. The board of directors for a company, along with management, determines the cash needs of the company over the next few years. They estimate cash inflows and all the investing opportunities or growth projects management would like to spend on, and if there's cash left over, instead of having it just sit there earning low money market rates, they can either issue a dividend or buy back the company's stock. Of course, a dividend, once started or increased, is a cash-hungry monster. The monster demands the same amount or more cash every quarter, and if that cash, the dividend, is cut, that monster destroys your share price. A buyback, though, is much more friendly. A board can use cash to buy back shares with investors getting no expectations for that future buyback, freeing up management and the board to spend cash however they need to in the future. So then a stock buyback is basically the same as a dividend, a use of excess cash, but rather than sending the money directly to investors, a buyback just increases shareholder value by increasing the earnings per share. Think about it this way. If a company reports $100 in earnings over the past year and has 1,000 shares outstanding, the earnings per share is 10 cents per share. If the stock price is $5, then the stock is trading for 50 times on that price to earnings basis, so price divided by earnings per share. Now, if the company buys back 200 of those shares, dropping the share count to 800 outstanding, then that same $100 earnings is now 12.5 cents per share. If the stock stays at $5 a share, then the stock is now trading for a much cheaper 40 times PE, a cheaper valuation there. Or if the market is still willing to pay that 50 times PE, the stock price increases to $6.25 a share. Now, we do see that the official research is mixed on whether a stock buyback is good or bad for investors. Despite the obvious upside, a buyback does signal that a company is maybe running out of ideas for growth. In theory, investors buy shares to see management grow the company, not just to send that cash back. But then that common sense evidence for buybacks benefiting investors, at least in the near term, is there. If we look at the change in shares and stock prices for the largest buybacks back in 2020, we see a clear picture here. 7 of the 9 companies decreasing their shares outstanding saw an average increase of almost 10%, while one company, AbbVie, increasing its share count, saw the stock price decline. Also, over the decade to 2019, research by Barini shows the companies repurchasing shares beat the S&P 500 by more than 7% on an annualized basis. Buyback companies saw a 400% return over the period versus 280% for those not buying back their shares. And of course, in the stocks to watch here, it's hard to ignore that $110 billion buyback on shares of Apple, ticker AAPL. The iPhone maker increased its buyback by 22% this year and adds to nearly $658 billion spent over the last decade repurchasing its own shares. In fact, Apple is annually the largest buyer of its own stock. Only Chevron and Alphabet have announced larger buybacks over the past decade. Now, with any of these stocks, you still need to look deeper into those fundamentals and decide if the stock is a buy. While Apple generated an amazing $106 billion in free cash flow over the last year and has nearly $42 billion in balance sheet cash, growth is clearly slowing down, and the company only expects to grow revenue by 0.6% this year and 6% next. The share repurchase will help increase earnings per share between 6 to 9% this year and next, but iPhone sales and activations are slowing globally. And more importantly, when thinking about the share buyback theme, is how many or what percentage of the shares outstanding are being taken off the market. At a market cap of over $2.8 trillion, even a massive $110 billion repurchase is really only 3.8% of the shares outstanding, so it might not boost the earnings per share quite as much as you'd think. Among the Magnificent 7 tech stocks, we also see huge buybacks from Alphabet, authorizing a total $70 billion buyback and issuing its first ever dividend of 20 cents a share. The stock popped 15% on the news, more from the dividend than anything else, but that $70 billion buyback is only 3.4% of the shares outstanding. Meta is also issuing its first ever dividend and announced a $50 billion buyback program during its earnings call. Here, the buyback percentage is a higher 4.5% of the shares outstanding, but the stock got hammered on its increased spending for AI and other projects. Here, though, we have to look deeper for the stocks taking more shares off the market, and one I've been watching lately is Adobe, ticker ADBE, last month announcing plans to buy back $25 billion in shares through 2028. This is clearly a value play. Management is saying it believes the shares are a steal at just 11 times sales, a 25% discount to the average 14.7 times price to sales ratio over the last 5 years. I've highlighted Adobe as one of the best AI plays in tech, dominating its niche in digital media and publishing. The company has already integrated AI into its Firefly and Sensei products, and the results are pretty amazing here. With generative AI prompts, you can change videos and images with just a few clicks. Adobe's Premiere Pro is already the leading video editing software, and this is probably going to keep it there. At a current market cap of $213 billion, that $25 billion repurchase could take nearly 12% of the shares off the market over the next few years. Another value stock here with a huge buyback program, shares of Alibaba, ticker BABA, which bought back almost $5 billion of its shares in just the last 3 months alone. On a recent bump in price, Alibaba has become one of the largest stocks in my portfolio, but should have more upside as value gets unlocked from segment spinoffs and AI development. And even as the stock trades higher though, BABA is still trading for a deep discount on its historical price multiples, both on price to sales and price to earnings. Earnings could be as high as $9 a share on $130 billion in sales this year, which would put the stock right at around 9 times on a PE ratio. And that buyback is taking nearly 2.5% of the shares outstanding every quarter, about 10% a year. eBay is also betting its shares are undervalued, announcing a $2 billion increase in its buyback program in February, now authorized to repurchase up to $3.4 billion, or about 13% of its shares outstanding. It didn't help the shares on the recent earnings results, but could go a long way to supporting the stock price as the company carries through with that program. Another stock to watch in this broader buyback theme is the Invesco Buyback Achievers ETF, ticker PKW, a fund holding companies that have decreased their shares outstanding by 5% or more over the past 12 months. The ETF buys and sells shares 4 times a year, so it's updated constantly for the companies with the largest buybacks. And while shorter periods may see the market outperform, the Buyback ETF has done very well since its 2007 inception, beating the market with a 320% price return versus about 271% return on the S&P 500 index. And even if you do decide to go with individual stocks here, the fund can be a great resource for the stocks to watch. Remember, you can go to the Portfolio tab on any ETF's website and see the stocks in the fund. Scrolling through this Buyback ETF, we see it's holding shares of buyback kings like T-Mobile, Johnson & Johnson, Comcast, Booking Holdings, and Lockheed Martin. It's not a green light to buy these stocks, but a good place to start your research into that buyback theme. Onto the stocks I'm watching this week, Rivian Automotive, ticker RIVN, is set to announce its earnings Tuesday, with the shares up 17% last week on reporting that the company is going to receive $827 million in incentives to expand its Illinois facility. Earnings estimates are still for a steep loss of $4 a share this year on growth of just 8.7% in revenue to $4.8 billion, though the quarter here is expected to see a 76% jump in sales. Now, with Ford pulling back on its F-150 Lightning program and pretty much all the other EV makers scaling back, Rivian could take a bigger market share over the next few years and surprise market higher. At this point, shares trade for just 2 times on a price-to-sales basis, clearly in value territory against a solid balance sheet. Anheuser-Busch InBev, ticker BUD, could surprise on revenue when it reports Wednesday, with sales expected just 1.4% higher and earnings basically flat from the quarter last year. It's been 3 months since Trump came out and said the company deserves a second chance after a boycott of Budweiser cost an estimated $395 million in sales last year. I'm sure there's still some holdouts that have switched permanently, but I also think the comparable sales numbers from last year are going to be very low and make it very easy for the company to show strong growth this year by comparison. Medical Properties Trust, ticker MPW, is up 71% from its January low as the company continues to use asset sales to pay down debt. The $1.1 billion deal to sell a stake in its Utah hospitals saw the shares jump 20% in a single day, and it now appears the company will have no trouble paying off its 2025 debt maturities. That's going to give it time to see a turnaround in its hospital tenants, and as highlighted in a recent video, shares continue to be too cheap to ignore here. Investors are going to get an update Thursday when the company reports earnings and could bring good news for the stock. SoundHound AI, ticker SOUN, also reports on Thursday, with the stock selling off from its March boom when Nvidia announced a stake in the company. Now, I've been holding the shares since about $3.77, since recommending it in February, and I think it could be one of the best tech stocks to buy on that AI theme. Near-term results are still going to be rocky, with the company expected to report a loss of 30 cents a share this year, but on 50% sales growth this year and next. Giving you the bigger picture here with the SectorSpiders.com sector tracker, 9 of the 11 stock sectors did close higher last week, with energy stocks falling again along with the price of oil, and financials suffering as consumers and the broader economy weaken. Now, this cyclical weakness is also evident in other sectors like industrials, which was only up 0.09%, and materials, which was only up 0.01% last week. These cyclical stocks tend to rise and fall at the first signs of economic strength or weakness, so investors using a swing trade strategy should understand how that works and plan their investing around important economic reports like the CPI and the monthly jobs report. Looking a little further out, stocks in the energy sector are now down 4.7% in the past month, with oil down 10% from its $87 a barrel on April 5th peak. With record production in the United States and weakening demand on the economy, the balanced price for oil is probably closer to between about $67 to $73 a barrel, so stocks in the sector may have further to fall over the next few months, unless of course we see another flare-up in Middle East tensions. Now, that said, long-term investors shouldn't worry about this, as most oil companies are operating at a cost of production right around $40 to $50 a barrel, so they're still very strongly cash flow positive. Oil stocks will continue to churn out those dividends, but growth in that dividend is going to slow from the pace we've seen over the past few years. Join me on the Blossom Investing app, see the stocks in my portfolio, and join over 100,000 investors with the link in the description below. Or click on the video to the right for the 10 stocks too cheap to ignore in 2024. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.